There's 33% chance that we're heading to a recession right now. Manufacturing is weak, consumer spending is slowing, unemployment is ticking up. But here's what the Wall Street doesn't want you to know. Some investments actually thrive during downturns. I analyzed 50 years of recession data and find 5 investments that consistently outperform the economy when it tanks. Let me show you how that works. The US recession probability hits 42% in October 2025, before recently dropping to 33%. Still way above the historical average of 15%. Whether we are technically in a recession or not, the bottom half of America is already feeling it. Rising delinquencies, falling savings, slowing wage growth. So here are 5 investments that historically protect your wealth when everything else is crashing. Investment number 5. Consumer staple stocks. Companies that sell stuff when you buy no matter what the economy does. You need toothpaste, toilet paper, groceries during a recession. And these companies have a pricing power and stable demand. During the Great Recession, Procter & Gamble stock recovered faster than any other broad market stocks. And during COVID's initial crash, P&G also demonstrated remarkable stability. In 2025 year-to-date, the TSX Consumer Staple Index is up 10%, beating the broad market by 3.6%. Costco generated $254 billion in sales in the fiscal year of 2024, with December sales up nearly 10% year over year, even during economic weaknesses. My top picks would be Procter & Gamble, which is P&G, Costco, Walmart in the US, and then Loblaw, Metro in Canada. And I rank this as a grade B. It is stable, but it's not spectacular. You won't get rich, but you're not going to get destroyed. Investment number 4, utility stocks. The most boring investments in the world, and one of the safest during downturns. People still need electricity, gas, water, no matter what. Regulated monopolies with government-backed rates and steady cash flow. Historically, Fortis has increased dividends for 52 consecutive years, including through every recession since 1973. Current yield is at 3.6%. During 2008 and 2009, utility stocks fell less than the broader market and recovered way faster. In Canada, defensive stocks in 2025 have delivered solid returns while tech stocks crashed. The BMO Low Volatility Canadian ETF is up 13.7% year to date with significantly lower volatility. My top picks would be Fortis FTS in Canada, NextEra Energy NEE, Duke Energy DUK in the US. I rate this as a A- for safety. Investment number 3, long-term government bonds. During recession, central banks cut interest rates, and when the rates fall, bond prices increase. You get capital gains plus steady interest payments. Historically, during the 2008 and 2009 recession, long-term US Treasuries returned 7 to 10% annually, while stocks crashed about 37%. And then in the 2020 COVID crash, government bonds surged as investors fled to safety. Canadian government bonds also showed similar patterns. And right now in November 2025, you can lock in for a 4 to 5% yield on government bonds. If recession hits and rate gets cut to nearly zero like it did in 2020, those bonds would appreciate significantly. But the catch is, if inflation stays high or rates stay elevated, bonds would underperform. But in a genuine recession with rate cuts, they're one of the best performers. My top picks would be the US Treasury for 10 years or longer, same as the Canadian government bonds, or the ETFs like TLT in the US or XLB in Canada. And I rate this an A for recession protection, but timing really matters. Investment number 2, dividend aristocrats. Companies that have raised dividends for 25 plus consecutive years, including through every recession. These companies have fortress balance sheets, pricing powers and cash flow so strong that they keep paying and keep raising dividends even when the economy tanks. During the 2008 to 2009, dividend aristocrats fell less than the S&P 500 and recovered faster. More importantly, they kept paying dividends while other companies slashed or eliminated them. Over the past 20 years, the S&P 500 low volatility high dividend index delivered 2.6% higher annual returns than the regular S&P with 10% less volatility. Here's the power move. Reinvest those dividends during the crash. You're buying more shares at a lower price, which generates more dividends, which buys more shares. Compound growth on steroids. My top picks would be Johnson & Johnson, J&J, Coca-Cola, KO, McDonald's, MCD. For Canadian, I would recommend TD, RBC, BMO, which all survived 2008 without cutting dividends. I give this an A+, which is best combination of safety, income, and long-term growth. Investment number 1, gold. And I know some of you are rolling your eyes, but data doesn't lie. When currency loses their value, economies collapse, and investors panic. Gold is the ultimate safe haven. Historically, during the 1970s stagflation, gold went from $35 to $850 per ounce. And during the 2008 financial crisis, gold rose while the stocks all crashed. And in 2020, gold hit an all-time high above $2,000 per ounce. And in 2025, gold is up 59% year to date, climbing from $2,500 to over $4,000 per ounce by November. And what's driving this? Central banks are stockpiling gold. 166 tons added to Q2 of 2025 alone, and they're diversifying away from the dollar. Major institutions like JP Morgan predicted that gold could hit $5,000 by 2026. The downside to gold is gold can be volatile. It dropped 3% last month, and it doesn't pay dividends. So you're betting purely on price appreciation and crisis protection. You can either invest in physical gold ETFs like GLD or gold, GOLD, or gold mining stocks like GDX for leveraged exposure. Miners return about 120% in 2025. I give this an A for crisis protection, but it is volatile, but it's still the ultimate insurance policy when everything else fails. Here's what you can do to build a recession-proof portfolio. You can put 30% into dividend stocks, and 25% into government bonds, 20% into consumer staples and utility, and 15% in gold, and save about 10% in cash. This mix protects your downside while giving you upside when the recovery hits. You're not trying to time the recession, you're trying to position yourself to survive and to profit from it. Look, I don't know if we're heading into recession tomorrow or next year, but the recession probability at 33%. Manufacturing is weak and consumer spending is slowing. It's time to get defensive. If this breakdown helped you understand how to protect your wealth during economic downturns, smash that like button and subscribe for more data-driven investing contents. And drop a comment below right now. Are you buying gold, dividend stocks, or going into heavy bonds? Let me know.